Measuring and reporting on sustainability. Sustainability has several challenges. We will look at these challenges as interdependency, maximizing social goods, externalities, and a case for sustainability. The definition of sustainability, given that sustainability is a broad concept having far reaching and varied aspects like climate change, globalization, living standards, it's a concept that requires considered thought for a definition. It's commonly defined as development that meets the needs of the present without compromising the ability of the future generations to meet their own needs. Shifting towards sustainability requires recognizing the larger context beyond economics. Second, it requires accepting uncertainty and ambiguity, given that the contemporary emphasis of enterprises is about economics. Third, it challenges the worldview of the managers in profit-making enterprises because the worldview is dominated by profit maximization. Fourth, sustainability emphasizes inclusion. That means requires consulting stakeholders to ensure that alternative viewpoints and values are considered by enterprises when making decisions. There are three aspects in sustainability, and they are interdependent. The first is economic, second is environmental, third is social. A key principle across time and space, these three aspects are implicit in the definition of sustainability, and it recognizes the importance of eco-justice and distributing planet's scarce resources. Involving staff and broader community in reducing waste, recycling materials, and using renewable resources are required by companies to decrease their detrimental impact on the environment, while increasing profits in a socially responsible manner. So working with staff, suppliers, customers, and communities to achieve social equity is proven to be good for many enterprises. The definition of sustainability, it cut across more than one generation, is to meet not only our needs, but the needs, not only needs of few selected countries, of a favored group within a society, but it recognizes the web of interrelationship that's required and systems thinking that has broader range impact over extended period of time to the globe. If you take, for example, a small pet store specialized in exotic reef fish, they might wonder what social and environmental impact their business might have. To do that, they might follow 5 steps. First, an enterprise must identify the problem. In identifying that problem, they have to look at what are the social and environmental impact from their activities. Second, collect relevant information. For example, fish are caught in the wild with methods that are not sustainable. That has to be corrected. Third, determine possible courses of action and their consequences. If suppliers can see the value of maintaining coral reefs, the local communities will have an incentive to care for those needs. Fourth, evaluate each possible course of action and select the best one. For example, purchasing fish coming from a certified provider who demonstrate not using destructive fishing practices would be one course of action. Fifth is to implement a decision to obtain information about the state of the reefs, working conditions of local people, and which enterprises have the best social and environmental practices. We also have to look at how sustainability can maximize social good. The societal values with regard to social and environmental performance are changing rapidly. This is the most dramatic in terms of the concerns for the health of the environment and the impact on the climate change. The social responsibility of enterprises is communicated to consumers through fair trade labels, specific industry certifications, such as Rainforest Alliances for coffee beans, and organization certification through World Fair Trade organizations. If the values demonstrated by an enterprise are consistent with individuals' values, the consumer's value, they're more likely to view the brand favorably. When we talk about sustainability, invariably we have to talk about externalities. Externalities means they are the unrecognized costs of production because the enterprises are either not paying or underpaying for it. In 1973, the American Accounting Association defined externalities as failure of the material decisions making processes to consider all the costs of producing and distributing the product. Ideally, they should be identified and allocated to individual firms whose actions cost them. Internalization of these costs would force managers to consider them along with other internal costs when making decisions about matters with environmental implications. The Cooperative Research Center for Coal in Sustainable Development determines that externalities exist if negative or positive impacts are generated by the economic activity and imposed on others. The impact is not already priced in the marketplace. For example, if the effect is negative, there's no existing compensation. One of the challenges when it comes to internalizing externalized costs is finding the true cost. For example, electricity. Finding the true cost of coal-generated electricity is difficult because there are costs that are not considered by enterprises. Either they are difficult to measure or difficult to identify, or their impact on the future generation is difficult to quantify. In other words, we use the definition of sustainability, and we can see there is intragenerational inequity and intergenerational inequity when electricity is underpriced for consumers because others now and in the future have to bear the cost for which they receive no benefit. It could be because the coal is generating pollution, and the pollution is then having an impact on the environment, on the plants, and having an impact on human in terms of their adverse health situation. The solution is to create incentives for enterprises to innovate. If enterprises are to include externalities into the enterprise cost structure, there has to be incentives to find ways to minimize these externalities. The cost of some of this environmental damage then needs to be borne by enterprises. For example, through fines. Fines and penalties are not always easy to predict, but they are not fully considered in decision making. Let's take James Hardie Industries. That provides an example of the difficulty in predicting the extent of such costs. When it comes to a long period, James Hardie Industries began to mine and process asbestos in the 1920s. At that time, asbestos was seen as a safe, inexpensive building product that had excellent fire retardant properties. We could argue that the product created positive externalities to the society, bringing benefits with lower hospital and insurance costs, with fewer fires. But after several decades, the dangers associated with asbestos came to light, and the full extent of the asbestos for businesses and its legacy to embrace sustainability is still unknown. There are a number of ways of addressing it. First is legal compliance. Second is enterprises take the stand of strategic philanthropy and align their charitable activities with social issues and environmental issues. Third is value-based regulation, where enterprises incorporate its value system and code of conduct to guide its behavior. Fifth is efficiency. Measures cost savings through efficient win-win scenario to the society, to the environment, and to the enterprise. The next and the last is the growth platform is to access new markets, new partnerships, new products and services through innovations that generate revenue. So what we can see from the legal compliance to growth platform is that the innovation is the driver. As more innovations that allow enterprises to accept externalities into their cost structure, but when accepting those costs are tolerable costs and can be included in the cost structure through innovations that lowers the cost, then there is an enterprise case for sustainability. There are various sustainability actions. Some are taken by people, some are taken with the intervention of government. There are voluntary action, then emissions trading schemes. There are two types there, baseline credit systems and cap and trade system. And thirdly, the direct action. The voluntary action is where enterprises voluntarily engage in sustainability. Partnering with major recycling company TerraCycle. They use Australia Post sachets and other packaging bags. They may be lodged at local post offices by claiming a free box or postage labels. Packaging waste is then upcycled into plastic park benches, chairs, and other industrial items. So these are voluntary actions taken up by enterprises. Another example is Mercedes-Benz, S-Class, and Daimler, Chrysler, the parent company. They use the renewable and recyclable materials for sustainability. They use coconut fiber for headrests. There is community support because there's increased income levels of 1,000 families in poverty-stricken parts of Brazil, which went up by 900%, because when Mercedes-Benz was buying this coconut fiber from these areas where people live, their income level went up. There's also a renewable resource that would otherwise be a waste product of coconut industry. And it becomes a cost to that producer to dispose it. There's also a savings to the enterprise of 5% in production costs. The coconut fiber provides a lighter and stronger headrest for the customer. Second is internalizing the externalized costs. Here we are looking at the government intervention or the market and the market intervention. We're taking emission trading schemes. Even if a firm itself is not a major producer of greenhouse gases that produces, for example, carbon dioxide, the cost of its input may rise dramatically as suppliers pass on their emissions trading costs. In Australia, coal-fired electricity generation is one of the major producers of carbon dioxide, the most common greenhouse gas. Although greenhouse gas reduction targets are challenging, we should not underestimate the power of the market to drive innovations. It's important that a united international approach is taken to decrease externalities, because the gas emissions begin to be borne by companies, enterprises. It is significantly increase their cost of production. The enterprises those are absorbing externalized costs as internal costs will be at a competitive disadvantage against those who are not doing it. The emissions trading scheme is designed to reduce greenhouse gas pollution by providing economic incentives to enterprises to achieve a reduction in greenhouse gas emissions. The value of emission trading, that is worldwide, is estimated to be $3.5 trillion US dollars by 2020, and is growing rapidly as countries join the international market. The emissions trading scheme has two categories in it. The first is baseline and credit system. It is where the government issue and buy back credit permits from enterprises. The second is the cap and trade system. Is the right to emit greenhouse gases, and then permits are bought and sold in the market. So the first one, baseline and credit system, there is government intervention. Cap and trade system is market-driven system. Baseline and credit system with greenhouse gas credits are issued and sold to the government. The firms reduce their greenhouse gas emissions, are issued with credits that can be sold to the government. So in that way, they can decrease their cost of production. Funds available from the government or from other organizations act as an incentive for enterprises to seek out innovative ways to decrease emissions. Cap and trade system through greenhouse gas credit at the market is a greenhouse gas credit is the right to emit a certain amount of greenhouse gas. Then government issues a certain number of these credits to key industries such as electricity producers. Enterprises can sell the unused credits, and this creates an incentive to decrease emissions for the enterprises that are typically polluting the environment. As the price of credits go up, cost of emitting the pollutants also increases. So the alternative is to pollute less with technologies becoming more economical and more competitive. Let's look at Australia's position. It's a cap and trade base. There was a cap and trade base emission trading scheme that was formally legislated and due to commence in 2010, and it was delayed, but later in 2014 it was repealed by that incoming government. A new direct action plan was introduced in 2014 to replace the former scheme, but with some characteristics of the baseline and credit emission trading schemes. It's called Emissions Reductions Fund that will directly support carbon dioxide emissions reduction activities by enterprises and industry. Then the government will pay for projects that will decrease carbon dioxide emissions at least cost. So the direct action plan works where the funding allocations from the emissions reduction fund is made through a reverse auction that is starting with the lowest cost projects. It identifies a range of possible opportunities to decrease carbon dioxide, such as energy efficient projects, cleaning up power stations, reforestation, and various revegetation projects and projects to improve soil carbon. There are a number of commitments, and these direct action plan commitments are 1 million solar roofs, solar towns and solar schools, 20 million trees to be planted, clean energy employment hubs, geothermal and tidal towns, renewable fuels, greenhouse-friendly program. Australia's emission reduction targets government has committed to decrease Australia's greenhouse gas emissions by 5% below 2000 target levels by 2020. Since coming into the government, the coalition has released the plan for a cleaner environment, and the Clean Air Plan indicates that this target will primarily be reached through the Emissions Reduction Fund, which is a centerpiece of the government's climate action policy. The government has indicated that once the budget for direct action plan is exhausted, no further funding will be given whether or not emissions reduction targets have been achieved. Let's now look at reporting on sustainability. We will focus on the Global Reporting Initiative framework. This is to report the enterprise's sustainability activities and actions to stakeholders. The Australian Sustainability Index was launched in 2005 to provide a comprehensive assessment of enterprises' economic, environment, and social performance. That's one of the indices that was provided for reporting purposes. The second was the AusSEE Index was made available to the public so that consumers and investors can evaluate enterprise performance. But for reporting purposes, the Global Reporting Initiative is widely used to show enterprises' commitment and serve as a benchmark for comparison with other enterprises. It has several aspects in that reporting. The foundation in that framework is the starting point of the reporting. The first aspect is the general disclosures, which start with Series 1, 100. It reports on enterprises' contextual information. The second is the management approach. Again, it's a 100 item. Reports on the management approach for each material topics on sustainability. There are 3 material topics: economic, environmental, and social. And then the 200 series and 300 series and 400 series items are about reporting on economic, environmental, and social. The framework has number of items, but the enterprises would choose relevant item from this framework for reporting purposes on economic, environmental, and social aspects for performance. Economic performance measurements. That's the 200 level items. There are 3 aspects in it. Is the economic, that's the financial implications and the risk and opportunities from engaging in sustainability. Then the market presence, that is the policy and practices and the proportion of spending on sustainability. Third is the indirect economic impact. It's about the development and impact on infrastructure investment and services provided primarily for public benefit. The environmental performance measurement, which is the 300 level items, have 5 aspects. Materials, it's reporting about the percentage of materials used that are recycled input materials. Then about energy, the direct energy consumptions by primary energy source. Third is about water, percentage and total water that is recycled and reused. Is about biodiversity. It's describing the significant impact on activities, products, and services on biodiversity in protected areas and areas of high biodiversity value. Fifth, the next one is emissions, the total weight of waste by type and disposal methods. Now, all these items may not be relevant to a given enterprise, so they will pick and choose items relevant to them. Social performance measures are the 400 items. There are 6 there: employment, labor and management relation, occupational health and safety, diversity and equal opportunity, about child labor, and about forced and compulsory labor, whether the enterprise use them or the enterprise return something to address these issues. The next is the social performance measures. They are the 400 items. It's about the rights of indigenous people, local communities, marketing and labeling, and customer privacy. So the GRI principles to define reporting quality and assess performance. The reporting has to be accurate and detailed, has to be balanced with positive and negative information, has to be clear, it should be meaningful and understandable, should be comparable over time with the same firm and with other firms, should be reliable through reviews and should report material items and should be timely so that stakeholders can make timely decisions. Sustainability also requires attention on its management. There are 5 aspects to manage sustainability: environmental management system, environmental management accounting, life cycle analysis and costing, capital budgeting, activity-based costing, and balanced scorecard. Environmental management system is the first one. It is to manage its environmental impact effectively. An organization must engage in necessary management activities of planning, control, and evaluation. Various standards exist to identify and benchmark key aspects of environmental performance. For example, the International Standards for Environmental Management Systems, ISO 14001, ISO 14004, are used by many enterprises in Australia and around the world. Here's a graphic of BlueScope State's environmental management system. It highlights the importance of translating the broad values of the enterprise into specific implications for day-to-day operations. So it starts with the policies and procedures, and these policies and procedures are then cascaded into codes of practice and guidelines, then into standards, then into principles, then policies, and their purpose of doing it. Second is the environmental management accounting. In environmental management accounting, it supplements the cost of accounting system by providing information about environmental impact on organizational activities. There are specific tools to include life cycle costings, which is similar to life cycle analysis, but with a focus on measurable costs and full cost accounting. There are various ways in which environmental objectives can be incorporated into cost management, such as activity-based costing that separate out the environmental costs. Although more than 30% of enterprises' resources are wasted, their cost is included in the product or service cost. Effectively hiding the waste and leads to incorrect pricing. So we can, through activity-based costing, we can separate out the waste and identify the actual cost rather than including them in the cost of the product. The solution is to provide separate account for waste that includes the cost of removal and cost incurred in acquiring resources in the first place. When we identify the waste, cost of waste separately, then we can look at that cost as a separate item and to find out how we can decrease the cost of waste. There are various ways in which environmental objectives can be included in cost management. One is life cycle analysis and costing. In life cycle analysis, it evaluates the product or service over its life and focuses on the financial costs incurred. Life cycle analysis begins to recognize some of the social and environmental impacts that can't be costed, such as amount of carbon dioxide associated with every stage of product's production and use. The move to life cycle analysis is seen as a way of broadening the focus from value generating for a limited use of stakeholders to recognize the cost through the product or service life cycle. In many cases, it is impossible or inappropriate to put a dollar amount on the costs imposed. So the life cycle analysis may focus on other measures, for example, quantity of toxic emissions. Third is capital budgeting. There are various ways in which environmental objectives can be included in cost management. One is to change over to reusable shopping containers or shopping bags to create cost savings for the enterprise and its customers. The cost savings to customers can provide the basis for negotiating a higher price. Some important aspects not easily quantified, for example, competitive advantage of reusable shopping containers in terms of employee safety. Risk is also an important factor in this capital investment decisions. For example, reusable steel shopping containers for transporting toxic materials may reduce the risk of a spill with its associated fines and impact on reputation. Fourth, the balanced scorecard. There are various ways in which environmental objectives can be included. Management accounting tools can be adapted to pursue social and environmental objectives. The balanced scorecard methodology can be used as a map to manage interrelationship between the drivers of social, environmental, and economic performance. Fifth is to justify the environmental performance economically. Is to recognize that all potential cash flows effects associated with the enterprise's environmental impact is impossible, but it increases the awareness, and that's important. Share price for a listed company is determined by anticipated cash flows and the risk associated with these cash flows. Enterprises have an incentive to demonstrate the market that they have effective systems in place to manage their environmental performance. The Pareto principle, which is 20% of production and activities to 80% of environmental costs, is another approach where the quality management approach. In this, the costs are categorized and can be applied to environmental impact management for prevention, appraisal, internal failure, and external failure. There are various strategies available for sustainability. The enterprise strategy requires a change in culture that must be infused throughout the enterprise. Learning for sustainability is to describe the ongoing learning that must occur within an enterprise to pursue on sustainability. Total quality management equally applies to sustainability in that journey, not as a destination, but as an ongoing process. Total quality management, the objective of sustainability are unlikely to be completely met, rather they provide the goal continuity to strive towards and emphasize on the rate of change. The planning tools could be used for strategic environmental assessments, environmental impact assessments, sustainable impact assessments, risk assessments, and cost benefit assessments. And environmental impacts of operations could be used for managing standards of using standards like ISO 14000 series and total quality environmental management. Common product and process design tools, environmental design and life cycle assessment, and monitoring and evaluation tools, effects on compliance monitoring, site, energy waste, health and safety audits to conduct and benchmark for performance. The social performance measurements under the GRI framework covers employment, labor and management relations, occupational health and safety, diversity and equal opportunity, child labor, forced and compulsory labor. It also covers rights of indigenous people, local communities, marketing and labeling, and customer privacy. The GRI principles for defining reporting quality to assess performance comprise of 6 attributes. It has to be accurate and detailed, balanced with positive and negative information, meaningful and understandable, comparable over time with the enterprise and with other enterprises, reliable in terms of the information has been reviewed and material, and it's available on a timely manner for stakeholders to make decisions. Sustainability also requires management. There are 5 aspects or areas that could be used for sustainability management. Environmental management systems, environmental management accounting, using life cycle analysis and costing, capital budgeting, activity-based budgeting, activity-based costing, and balanced scorecard. Environmental management system manage its environment impact effectively. An enterprise must engage in the necessary management activities of planning, control, and evaluation. There are various standards exist to identify and benchmark key aspects of environmental performance. For example, the ISO 14001 and ISO 14004 are used by all enterprises in Australia and around the world. BlueScope Steel's environmental management system highlights the importance of translating broad values of the enterprise into specific implications for day-to-day operations. It starts with its vision, policy, then outlines principles, then standards, then the corporate policies, procedures, and code of practice and guidelines, then the business and sub-business policies, procedures, codes of practice, and guidelines. Second is environmental management accounting. That is to supplement the cost accounting system by providing information about environmental impact of the enterprise's activities. Specific tools including life cycle costing, which is similar to life cycle analysis, but here with a focus on measurable costs and full cost accounting. There are various ways of including cost management, such as activity-based costing, to separate out the environmental costs. Although often more than 30% of enterprises' resources are wasted, those costs are included into the product cost. This effectively hides the waste and leads to incorrect pricing. The solution is to separate the waste cost so that the enterprise can focus on waste reduction. There are various ways in which environmental objectives can be included in cost management. One of them is life cycle analysis and costing. Life cycle analysis evaluates a product or service over its life. Life cycle cost, on the other hand, focuses on the financial costs incurred. Life cycle analysis begins to recognize some of the social and environmental impacts that can't be costed, such as the amount of carbon dioxide associated with production and use. The move to life cycle analysis is broadening the focus from value generation for a limited group of stakeholders to recognizing cost throughout the product or service life cycle. It's impossible or inappropriate to put a dollar amount on the cost imposed. So life cycle analysis may focus on other measures such as the quantity of toxic emissions. The third is to use capital budgeting towards environmental objectives. It can create cost savings for enterprises and its customers. The cost savings to customers can provide a basis for negotiating higher prices. Some important impacts, for example, are the competitive advantage of reusable shipping containers in relation to employee safety. Risk is also an important factor in capital budgeting decisions. For example, reusable steel shipping containers for transporting toxic materials may reduce the risk of a spill with its associated fines and impact on reputation. Fourth is the balance scorecard to manage costs. Management accounting tools adapted to pursue social and environmental objectives. For example, a balance scorecard methodology can be used to map and manage interrelationships and drivers of social, environmental, and economic performance. Fifth is justifying environmental performance economically. That is, to recognize all potential cash flow effects of the enterprise environmental impacts is impossible, but increasing awareness is very important. The share of price for a listed company is determined by its anticipated cash flows and the risk associated with these cash flows. Enterprises have an incentive to demonstrate to the market that they have effective systems in place to manage cash flows. That includes environmental performance. The Pareto principle states that 20% of production activities are responsible for 80% of environmental costs. The quality management approach, in which costs are categorized and applied to managing environmental impact, includes prevention, appraisal, internal failure, and external failure. Strategy for sustainability is to shift enterprise strategy as required to change its culture that infuses throughout the organizations. It also must learn for sustainability as an ongoing project. Total quality management also applies to sustainability as a journey rather than a destination. The objective of sustainability are unlikely to be completely met, but they provide a goal to continually to strive towards the emphasis that is placed with a rate of change. There are tools for social and environmental issues, planning tools to assess environmental impact, strategic impact, assess the risk, and cost-benefit analysis. There are also tools to assess impacts on operations, such as ISO 14000 series. There are also common product and process design tools for environmental design and life cycle assessment. The monitoring and evaluation tools to monitor energy waste, health, safety audits, and benchmarking